Most agency owners are missing a legal tax strategy that may be sitting right inside their own home. And the frustrating part is, it's not complicated. As I like to say, it's not rocket science. But if you document it wrong or treat it casually, the deduction can fall apart. Today we're talking about the Augusta Rule and how marketing and PR agency owners can use it the right way. I'm Craig Cody, I'm a CPA and I'm a certified tax coach. At Craig Cody & Company, we help marketing and PR agency owners keep more of what they make through proactive tax planning and better cash flow forecasting, along with financial clarity. In this video, I'm going to explain what the Augusta Rule is, how it can apply to your agency, where agency owners usually get it wrong, and what documentation you need before you ever write the check. This is not tax preparation, this is tax planning, and there's a big difference. What the Augusta Rule actually does. Let's start with the basic. The Augusta Rule allows you to rent your personal residence to your corporation or your partnership for up to 14 days per year, and when done properly, your agency gets a deduction for the rent, and you receive the rental income tax-free. So let's say your agency rents your home for a leadership planning session, a quarterly strategy meeting, or a team training day. Your agency pays fair market rent for the use of that space. The agency deducts the rent, and because the rental period is 14 days or less, the income is not taxable to you. And that sounds almost too good to be true, but this is exactly why proactive tax planning matters. The tax code includes strategies business owners can use legally. The problem is most accountants are looking in the rearview mirror. They're filing forms after the year is over. They're not sitting down with agency owners during a year and asking, what are you already doing that we can structure more intelligently? And that's where agency owners lose money. Not because they're doing something wrong, but because they're not planning early enough. Point 2 is the 14-day limit is not per business. Now here's where some agency owners get themselves into trouble. They hear 14 days and think, great, I own 2 businesses, so maybe I can rent the house 14 days to one company and another 14 days to another company. That's not how it works. The 14-day limit applies to the resident, not to each business. So if you and your spouse each own a company, you do not each get 14 days each, so 28 days of tax-free rental income for the same home. The combined limit for that residence is still 14 days. Now, if you have more than one qualifying residence, that may be a different conversation. But for one physical home, the rule is 14 days. And this is important for agency owners who have multiple entities. Maybe you have an agency in one company, a media buying entity in another, or a separate consulting business. Do not assume each entity gives you a new 14-day limit, because that assumption can create a problem. And this is why the structure matters, the entity matters, and the documentation matters. The business purpose matters. Point 3, it has to be real business use. The Augusta Rule is not a blank check. Your agency needs a real business reason to rent the home. Think about legitimate agency uses. There's many of them. A quarterly leadership meeting, a planning session for next year's agency goals, training your account managers on a new client delivery process, an employee event that is clearly tied to the business. Those are the types of uses that can make sense. But here's the line you do not want to cross. And I mean, do not turn this into entertainment. If the event becomes entertainment focuses, or you start inviting family members and call it a business event, you have a problem. For agency owners, this is especially important. It's easy to blur the line. A leadership offsite is one thing, a dinner party with a loose business agenda is another. A team training day is one thing, a social gathering with no real business purpose is another. You need to be able to show what happened, who attended, why it mattered to the agency, and how it connected to the business. And that may sound basic, but basic documentation is often what saves a strategy. I have a quick question for you. Have you ever used your home for an agency meeting, a leadership session, or a team training day, and never treated it as a business rental? Drop your answer in the comments. I read them all. I think a lot of agency owners are going to recognize this missed opportunity. Point 4, fair market rent is the key. And let's talk about this number. You can't just pick a rent amount because it feels good. The rent has to be fair market rent. In plain English, that means what a third party would pay, for a comparable space in your market for the same type of an event. So what do you do to gather the proof? Get quotes from a local hotel for meeting rooms. Look at the small event places, look at private clubs, look at retreat style venues, find comparable spaces that match what your agency is actually using. If you're using a large room for a full day leadership meeting with 12 people, compare it to a meeting space that could reasonably handle that. Do not compare it to something ridiculous. Do not inflate the number. You want reasonable proof in your tax file, and you want that proof before the question ever comes up. This is where tax planning and tax preparation are very different. Tax prep says, what happened last year? Tax planning says, let's build the file correctly while we still have time. That's the difference between hoping a deduction holds up and knowing you handled it properly. Point 5, the paper trail matters. Here's what I want in the file. An invoice from you as the homeowner to the agency, payment from the agency to you, proof that the rent was fair market value, proof of the business purpose, the agenda, the attendee list, meeting notes, training outline, pictures of the setup if that helps. And if the rent paid is $2,000 and more, the corporation must issue Form 1099 miscellaneous. And now some owners will hear that and say, well, if the income is tax-free, why issue a 1099? Because you want the transaction to look, feel, and be businesslike. The IRS matches 1099s, so your CPA needs to report the income properly and zero it out using the Section 280A sub G exclusion. Don't freestyle this, don't ignore the form, don't assume tax-free means invisible. Tax-free does not mean undocumented. So some key takeaways here. The Augusta Rule may allow your agency to rent your home for up to 14 days per year. Your agency may deduct the rent. You may receive the rental income tax-free, but the strategy only works when it's handled properly. The 14-day limit applies per residence, not per corporation, and the event needs a clear business purpose. The rent needs to be fair market value rent, and the documentation needs to be in place. This is not about being aggressive. This is about using a court-tested, IRS-approved strategy the right way. Agency profit is not just about selling more retainers or improving utilization. It's also about keeping more of what you already make. That is what proactive tax planning is supposed to do. If you own a marketing or PR agency and you're not sure whether the Augusta Rule fits your situation, don't guess. Get a proactive tax planning review. At Craig, Cody & Company, we help agency owners look ahead, not just clean up history after the year is over. Remember, the goal is simple: more profit, less tax, better cash flow, and a plan you can actually defend. Thanks for watching, and remember, it's not what you make, it's what you keep. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.